Well, thank you very much, everyone. Thank you, ALMUS, for inviting me to this conference to present to you on the views on G10, emerging markets. This is what we're really thinking in terms of some of the themes for this coming year ahead. What I'd say to you, firstly, is I actually broadly agree with Dr. Sheila Goel's views on INR. I do think fundamentally there is actually a very strong rationale over the medium term for INR to actually be an outperformer, to even appreciate, particularly on a real effective exchange rate basis. What I would say to you though is, this is much more kind of medium, long-term view. Unfortunately, the view from Nomura is one which, over the next 3 to 6 months, there's going to be a lot more challenges. So the challenges that were talked about just earlier were about all the tweets that kept coming through. I think, of course, that's going to remain a problem that we'll have to face and deal with almost on a daily basis. But I would say that there is more fundamental factors that we should focus on. The market, for example, I would say it's actually starting to get quite excited about the prospect of a softer dollar. I think over the past maybe 2-3 weeks, people have started to discuss the view of the US potentially slowing down, talking about how this loss in the Congress, in other words, the Republicans losing the House, may actually result in Trump not being able to push through investment, fiscal stimulus. So there's all this discussion about this potential extreme words of fiscal cliff that could come through in 2019. What I'd say is that yes, this is an interesting theme, one that of course could transpire, but is this the time to really think about it? Because as far as we see it, the data in the US and the data in Europe still continues to broadly diverge. So when, what I have here, it's hard to see the numbers, I apologize for that, but I think luckily I've got colors here. So if you look at this economic heat map that I have up here, if you concentrate on the color scales, top one is the US economic heat map. So I've looked at data such as inflation, I've looked at things like the manufacturing ISM, I've looked at consumer confidence, I've looked at industrial production as well, and I've done a comparison with Europe as well, so the Euro area. And what you can see here is, over the past 16 months to the latest date of data, broadly speaking, we have seen really strength and continuous strength coming out from the US. Whereas in Europe, we've actually moved through this phase of this green, which was actually quite strong data, towards yellow and towards red. So to me, this is actually quite important. It's quite a simplistic thing to think about, just kind of growth differentials. But it's something that's continuing. This differential, this divergence is continuing. And if we actually look at these specific months and try and overlap that with, for example, the DXY or the euro dollar, you'd actually notice that the dollar strengthened, dollar weakened. We had euro dollar trading up to about 1.25, all the way through into the first quarter of this year. And since then, as the data began to deteriorate, we had actually the euro weakening. And because of the outperformance of the US, the euro dollar effectively fell from 1.25 to where we are now, about 1.14 in the region. So the question is, do we see this continuing? And as I mentioned, there is that scope that we could have some convergence coming back. And I think this convergence will be very important, because if we do have US growth slowing down, and of course converging towards European growth, I think that is, to me, some rationale why the euro can actually strengthen back against the dollar. Plus, of course, the consequence of this will be policy as well. This policy divergence that we're seeing. So if you look at the chart which we have on the bottom right hand side, just looking at the expectations, what's happening in terms of, for example, Fed funds rates, the expectations in the market, versus Europe, where I'm looking at EONA rates, there's this big divergence, so we can see the convergence come back as well. So this is something I think is a theme that is starting to develop. Perhaps it's a little bit too early to think about this as something that's going to happen in the next 1, 2, 3 months. But I think this is very important for all of emerging markets. Now, how this comes through as well is very important. So in other words, if I was to say to you, my view is strongly that I think US is going to be slowing, Europe probably remains kind of stagnant, a little bit of a pickup, then actually for emerging markets, that's not so great news. So even if I can say to you, I think the euro dollar will be higher on the back of this convergence trend that's led by the US, actually I'm not so excited about this for emerging markets, because I think the problem with this is that you will have a potential slowdown in global demand, which will not be good for emerging markets. The best case scenario for us would be to see this growth convergence come through with Europe picking up. And of course the policy, if I want to say policy normalization, expectations of Europe actually normalizing at a faster rate ahead as well. I think that would be a much more kind of bullish scenario for me in terms of emerging markets. But for now, it still doesn't look like that. There's glimpses of the negative scenario coming through, and that's being led by growth in the US potentially slowing down. Again, this is a theme which I think will keep, right now, the euro dollar depressed. I think as we move into next year, where we could see this potential slowdown in the US, this is when it will become a little bit more exciting for the market, and we can see the negative impacts come through for emerging markets. And related to this as well is the policy normalization, which we at Nomura expect to continue. So we are effectively on full-fledged balance sheet reduction from the Fed. $30 billion in terms of US Treasuries, $20 billion in terms of agency mortgage-backed securities as well. Europe is actually moving on the same kind of direction. Although the balance sheet is still increasing, they have reduced their balance sheet purchases. So now we're running at a rate of around 15 billion euros, and the expectation is that this will fall to zero by the start of next year. So the whole balance sheet reduction process, in my view, is something that will continue to, if you want to say, hurt emerging markets. You know, this excess amount of liquidity that we all enjoyed post-2008. This is something that looks like it's going to be on a reduction and constant reduction path ahead. So for me, I would say you've got to watch out for one thing, and we've obviously seen signs of this emerging already. Throughout this year, we've had outflows from equities, we've had outflows from bond markets. This is a concern that I still have at this point in time. Now, you could argue and say, well, we've seen some risk premium return to the markets. Real rates in a lot of countries are high, FX valuations have improved drastically as well. The whole valuation picture actually looks better, which I kind of agree with. I think things have really improved. But the problem I have is that if you're having some of these fundamental drivers in place, whether it's about this divergence in US-European growth, whether it's about the constant policy normalization, rates are going to be consistently raised in the US, whether it's about balance sheet reduction as well, it's quite hard for me to become overly bullish on emerging markets and in Asia, particularly at this point in time, when I could quite easily put the point forward that even though you've had an increase in if I want to say, risk premium in some of these markets, you look historically, it actually still doesn't look that high. So it's still a bit of a concern. The other thing I've just mentioned here is the positioning has been reduced. It has been reduced. But the fact that we've had roughly 2.4 trillion US dollars of inflows into emerging market bonds and equities since QE1 is, in my view, a little bit worrying. So when we focus on particular markets, specifically in Asia, where this positioning has increased, I would say it's clearly in equities such as Korea and Taiwan. This is where the money really has piled in since QE1 from the Fed. And then of course when we look at some of the bond markets, It looks like Indonesia, as mentioned earlier, Indonesia is one market which has seen a substantial amount of inflows. So it's a really bit of a mixed picture on the positioning. Positioning has broadly decreased, but in my view, positioning is still really quite elevated, particularly in parts of Asia as well. So if these themes continue in the coming months, which I assume they will, then I do see some risks to kind of broad Asia FX emerging markets as well. One thing which I think people don't really talk about much, right now it's still very much discussion about policy normalization in developed markets and how that's going to create and result in capital outflows from the portfolio side, bonds and equities. Everyone's focused on bonds and equities right now. One thing which I think we need to focus on, because this could be a risk ahead as the policy continues to normalize. The risk is, we're seeing, for example, LIBOR rates continue to rise. We're seeing, obviously, there's a lot of loans which are linked to LIBOR as well. This, to me, is a bit of a concern. It's not so much about external debt. I think external debt, broadly speaking, in emerging markets, there's not any particular red flashing lights out there. It's not like before the Asia financial crisis, where external debt was extremely high versus GDP in Asia, and it was clearly a problem once we started to see depreciation, obviously the ability to pay back this debt. External debt, in my view, is not a very big issue. There are some countries which are facing a little bit of stress, but broadly speaking, there's no big concern. The concern that I do have is actually looking at local debt. So the private non-financial sector debt is something which is a little bit elevated in parts of, in particular, Asia. Not so much the rest of EM, but Asia. So where in Asia, where we're seeing this, is mainly Northeast Asia. So India is not in that camp, but Northeast Asia is where this risks lie. And I'd say going a little bit more south, we see relatively high levels of local debt in Singapore and in Malaysia as well. So the concern that we have is when we think back and look at the debt servicing costs, when we were looking back at, for example, 2007, right, you would have expected debt servicing costs being relatively high because we had not gone into this whole QE policy, lower global rates backdrop, and they were high. The issue we have now is that, believe it or not, the debt servicing for most of the countries in emerging markets is actually even higher, even with the fact that yields globally had moved down through this whole QE process. So I think that one of the problems that we've seen is that the actual stock of debt has increased quite substantially. So I would say this is something we need to focus on here. There are pockets of stress that are starting to build up in some emerging markets on the back of this. We're seeing it, for example, in China. The negativity around the high levels of debt, right? And the cost, obviously, the cost of financing haven't risen, but now starting to reverse. The policymakers are quite desperately trying to reverse the high financing costs because of obviously the defaults that can come through on the back of this. We're seeing some concerns about Hong Kong in terms of the property prices, some concerns about leverage in the property sector as well. So just be aware that there are pockets of risks within EM. It's not just about portfolio flows, it's not just about bonds, equities, it's actually about leverage as well. And clearly what we've got to be aware of as well is whether there's any kind of contagious impacts on the back of this. China having some negativity around its debt will definitely have a substantial impact on the rest of Asia as well. Now on oil prices, this is clearly another concern. The good news is that oil has come off. When I was creating these slides, I was just watching the oil price consistently fall down. I was thinking we should actually reverse the analysis to look at how much it impacts on inflation on the downside and improvements in the current account. Well, the good news is, you know, the Nomura economists have actually done this analysis, and given it was only a $10 analysis change, if you flip it the other way around in terms of fall, the actual impacts are roughly symmetrical. Obviously, it becomes non-symmetrical as oil moves even more drastically. But what I'd say to you is that clearly this is quite good news for EM, particularly, you know, Asia. Asia is one of the biggest net importers of oil, and of course it's relatively good news for, I'd say, Eastern Europe, emerging markets as well. For LATAM, probably not so good, given that quite a lot of them are net commodity exporters. But again, I want to just highlight one thing. This fall in oil prices may be viewed as positive in terms of current account positions, and I would completely agree with you know, the analysis that this could result in, for example, India's current account position improving quite drastically. The only issue I have is that if you truly believe that this is a supply side led drop in oil prices, then I would say this is much more positive. So if it's about OPEC increasing supply, which I think probably was some of the rationale, particularly with Trump obviously pressuring Saudi Arabia to increase supply, then that could be viewed as positive. The issue I have is that if this is demand-led fall in oil prices, then I'm a little bit more cautious. In other words, I would actually think that the current account position can improve, but the problem could be because global growth is slowing. You could actually have a negative impact on the capital financial account. So the risk that you could actually see more pressures on portfolio outflows is something that I think is a little bit of a concern to me. I mean, for India's case, I would say, you know, I was meeting some official yesterday, and a view that came out when I was asking about lower oil prices, which I think is quite valid as well, is that yes, we will see improvement in the current account. Yes, we will see some deterioration in capital outflows, meaning the short-term capital flows. But the good news is that the long-term flows are still very much intact. In other words, the net FDI flows. So I think overall the negativity around a demand shock impact on oil, I think it will be there, but I don't think it's really that substantial. But nonetheless, just be cautious on overplaying the fall in oil prices. So again, if it's demand-led, be a little bit more cautious, because I think that's not necessarily a good thing for emerging markets, given that emerging markets, broadly speaking, are very dependent on growth. And then the trade protectionism, this is the tweet world, you know, where I have to try and stay up 24 hours watching for Trump's tweets. I just say one thing, and that is, it does feel that, and again, I completely agree with Dr. Shimagawala, it does feel like something could be improving on the trade side. That there are discussions going on at the high level, mid-level, and low level between the US and China. The only issue I have is it's beyond trade. You know, this is about also China trying to become a world player. You know, this made in 2025 desire that China has. And then, of course, it's about intellectual property theft as well. So it's if it was just about trade, I truly believe that it would be solved very fast. In fact, it almost got solved. If you think back in May when we had the US Treasury Secretary meeting up with Vice Premier Liu He. You know, there was all this back and forth about, okay, we will import $50 billion. No, we want you to import 200, and it almost went halfway to 100. But then Trump came in and stopped the whole process, because, as I said, it's not just about trade, it's beyond trade. So I think the best case scenario that we can expect at the end of this month, when Xi and Trump actually meet, is that there could be some form of de-escalation, pausing on the various tariffs that could come through from the US, and an agreement to actually push forward with more talks. Now, I'll be very frank, this is not an extremely strong view I have, given that I'm facing all these tweets all the time. But I would say that looks like the most kind of likely outcome at this point in time. Though I would say that, you know, if the discussions don't go well at the G20, then you will see, in my view, a quite significant intensification between the US and China. US will go through ahead of 25% on $200 billion and could even, you know, intensify this even more. And then from the China side, you know, China's kind of running out of bullets to fire on the trade front. One thing I would highlight to you is that some ex-Chinese officials, such as the finance minister, have actually suggested other methods in which to retaliate against the US. And these methods are actually really quite scary when I think about it. It's mainly to actually potentially target some of the US corporates that are based in China. Whether that's slowing down, you know, potential exports, whether that's even affecting some of the supply chains as well. So that to me is a big concern. That would be the big step up in trade protectionism, which would severely negatively impact on Asia. And the way we've looked at this is, for example, I'm not sure if you can see the screen, but top right hand side, we've looked at some of the US companies which are based in China. And we've looked at their major suppliers as well. So the good news is that it's not mainly supplied by Southeast Asia companies. It's mainly supplied by Taiwanese companies. But I think the point here is that if trade protectionism picks up, it's not just about hitting China. Actually, the risk towards broad Asia and emerging markets is very substantial. It's not just about the direct channels, it's the indirect channels, which we need to worry about. Supply chains. We need to worry about the corporate revenue impacts as well. What we've noticed is that a lot of countries, particularly in Asia, are highly dependent on their corporate revenues from China. And clearly, if there's any kind of negativity around Chinese growth or impacts on supply chains, this could be a severe impact on Asia equities, and I would say broadly emerging market equities as well. So just watch this development. I do think that it's broadly improving, but again, you know, this is something I have to watch very closely, particularly as we go into the G20 this month. So, without going further into, you know, all these kind of risks, you know, I talked about US, European, this convergence risk, maybe led by the US. I talked about DM policy normalization. I talked about, you know, some of the positioning in these markets as well, the risks to more capital outflows, leverage and oil prices, and of course China-US trade. These are all headaches that we're going to have to face. Unfortunately, my view is that I don't think these headaches necessarily go away in the coming months. I think it's going to take us into maybe the first quarter of next year before some of these things will be more resolved, more clear. What I would highlight now is that even with those concerns we have, I don't actually believe we're going to go into a situation where there's going to be some massive crisis within Asia or even within parts of the emerging markets. And the reason why I say that is, again, just you know, reflecting on earlier speaker, I think there is still significant room for defense. Broadly speaking, within Asia, reserve adequacy, in my view, is still very high. There are some pockets of weakness out there, like for example, I'd say Indonesia maybe sticks out. When I'm looking at IMF reserve adequacy ratios, I can see that it's roughly around 100% adequacy on an average basis, depending on which FX regime we look at. But broadly speaking, within Asia, it is in a healthy position. You know, for example, India, according to the measurements under the IMF, actually has substantial reserve adequacy, about 240% reserve adequacy. So I do think that, you know, the kind of line of defense where we're seeing the reserve drainage actually can continue. There's an ample space to continue to drain reserves as the first line of defense. And I think that's broadly the case as well for most of emerging markets. The only places which really do cause a little bit of concern to me is Turkey and South Africa, where the reserve adequacy ratios are actually quite low. And given all the stress they're facing and the current kind of deficit, financing difficulties as well, that's probably one source of concern. What I would say as well is that we shouldn't just ignore this as well. I mean, there's been many instances this year where Turkey has faced a lot of pressures, and you see this contagious effect actually come through to the rest of emerging markets. And I think one thing we need to be aware of is the integration of global markets. The financial market developments, the asset managers, which are multi-asset, multi-market investors as well. If there is a shock in one country such as Turkey, there's always this value at risk play. We could see significant reductions in terms of positions there, which maybe they can't finance, and hence what they have to do is sell the other assets. And that's typically what's happened. We've had a few shocks like that before. Turkey almost created that shock this year, back in May. And then we actually had a VAR shock, if you remember, in Russia as well, back in the end of 2014. There was also this VAR shock that came through to the rest of Asia. So there is defense for sure, but I would not be ignorant of the risks around the potential contagious effects if something was to come through. And actually, just to expand on Dr. Goel's analysis, so this is Nomura's FX valuation analysis as well. So as I said earlier, we do think that valuations have improved, definitely. And so, just looking at the various models that we have, current account based models, PPP models, real effective exchange rate adjusted for productivity as well. These, I should show you a chart actually of the improvements over time, but I would say broadly there has been a significant improvement in valuations across most of emerging markets. Indeed, if you look at average valuations for whether it's Latin America, EMEA or Asia, the undervaluation is clearly there. So there is some value from currencies given the recent sell-off that we've seen. But again, as I mentioned earlier, just be very cautious on this, because if the underlying global themes are still very much in place, geopolitical normalization, trade protectionism, all these issues I mentioned, valuations to me are a sideline issue. It's not something that we should really be focusing on at this point in time. Until there's a fundamental change, then we can focus on valuations, and then there really will be a rush to search for where markets are cheap. This is my last slide, just to highlight what could go wrong with my view. So as I said, I'm slightly off the view that dollar is bid, probably remains bid towards the second quarter of next year. But what could change this is these factors I mentioned here. So clearly, if the market starts jumping on the view that the Fed cycle is reaching maturity, and I think that could be the case as we get into the start of next year. Clearly, if we do see a reconvergence, right, as I mentioned, between the US and Europe, led by Europe, that would be a very bullish sign for emerging markets. China, fiscal stimulus, right now it's been very targeted, too targeted, and growth is still slowing. I think, unfortunately, what we may have to see is a much more substantial fiscal package come out. I'm not saying we get the 4 trillion that we had back in 2008, but we're talking about a much more aggressive fiscal stimulus, and that could change the sentiment in emerging markets as well. We could see emerging markets, at least for a few months, rallying on the back of this. And then, of course, protectionism, it's still hard to tell, but if we do see this improvement coming through, then I think, generally speaking, within EM Asia space, we can also benefit. And lastly, just continuous reforms, right, to try and narrow current account positions. We've seen that coming through in a few countries in Asia. Indonesia is for one, which has implemented a lot of measures to try and narrow its current account deficit. I think if we see that kind of action coming through, as well as, if you want to say, more proactive monetary policy as well, not lagging, but actually proactive monetary policy, then I think the kind of vulnerabilities around emerging markets will fall as well. So I'm going to just end it there now, and I believe we're going to move to panel soon.